All right, it's November 7th. The objective today is simple. Find the signal through all this noise. We're looking for a clear, actionable thesis for the next 1 to 2 weeks. Let's get to it.
Okay, right out of the gate, we're seeing investor sentiment in extreme fear. Now for us, that's the starting line. When fear gets this high, it's often a signal that opportunity is knocking for anyone with a disciplined, data-driven plan.
So what's clouding the tape? Well, it's a mix of that extreme fear, the usual political gridlock, and frankly, flawed data. Some of the source material coming across the desk today had some pretty significant errors. In an environment like this, a clean signal isn't just nice to have, it's absolutely essential. So that's our job today. We're going to cut right through all of that. Filter out the headlines, ignore the conflicting reports, and isolate a high-conviction signal for that 1 to 2 week time frame. That's the focus.
Okay, let's start filtering. When you boil it all down, there are really only 2 critical headwinds that matter right now. These are the primary drivers we need to watch for the near term.
All right, let's break these 2 down. On one side, you've got the government shutdown. This is all about political gridlock, and its impact is very direct. It's a measurable operational risk hitting specific sectors. It's an event-driven thing, happening right now. On the other side, you've got Fed policy uncertainty. That's a broader risk, right? It creates market-wide volatility, and it's an ongoing data-dependent story. But here's the key. For our 1 to 2 week horizon, the shutdown is the variable that's immediate and, more importantly, actionable.
And that brings us right to the point of impact. This is where that big picture macro risk funnels down and becomes something measurable on a micro level. And right now, that's pointing us directly at the airline industry.
So here's the core thesis, plain and simple. The shutdown isn't some theoretical risk. It's a live, active stress test being put on the U.S. airline industry right now.
Let's break down exactly what that stress looks like. First, air traffic controllers are working without pay. That's a huge morale hit. On top of that, the system was already understaffed before this all started. So what's the result? Airlines are being forced to reduce flights just to maintain safety. Now, for us traders, this translates directly into elevated implied volatility. You're seeing it in jets, AAL, UAL, and of course, the headline risk is through the roof. The tape is moving on every single political whisper.
Now this number right here, this is a critical piece of the puzzle. Sources are estimating just a 1 to 2 day normalization period for air traffic once this thing is resolved. Think about that. That short duration means any potential recovery isn't going to be a slow grind up. It frames it as a sharp, fast, event-driven snapback.
Okay, so with that data point in hand, we can now build out a real strategic framework. We're going to look at 3 potential scenarios, and they all pivot on one single catalyst: the timing of the shutdown resolution.
All right, before we get into the scenarios, some mandatory disclaimer. Just remember, this content is for educational purposes only. I'm aggregating public sources to help you stay informed and sharpen your own decision-making. So please do your own research. This is not financial advice.
And a quick note, if this analysis is helping you cut through the noise, please take a second to like and subscribe. Your support really does help the channel reach more viewers. It's greatly appreciated.
Okay, here's the framework. Let's start with the bull case. A quick resolution, we're talking under 3 days. If that happens, you're looking at a sharp relief rally in the airlines and a significant IV crush. Your signal is an official announcement of a deal. Now, the base case, maybe the most likely. A brief shutdown, say 3 to 5 days. You'd expect an initial dip, then a partial recovery. For that, you're watching FAA statements and airline capacity announcements. And finally, the bear case. This thing drags on for more than a week. That means more downside, and you start worrying about permanent staff loss. The key indicator there? Negative reports coming out of the ATC unions.
All right, so we have the scenarios. Now let's translate this framework into a couple of actionable risk-defined option structures that fit our 1 to 2 week time frame.
First up, setup number 1. This one is built around the bull thesis, positioning for that quick resolution we just talked about.
So for this, we're looking at a call debit spread on the JETS ETF, probably using the November 21st weeklies. Why the structure? Because it lets you express a clear bullish view with your risks strictly defined from the start. It's designed to do 2 things: capture that snapback relief rally and benefit from the IV crush that's likely to come with a resolution. Your max loss is simply the net debit you paid to get in. And your invalidation point? A break of recent support or, obviously, any news that the shutdown is being extended.
Now, for balance, you have to have a plan for the other side of the coin. So setup number 2 aligns with the bear thesis, positioning for this shutdown to drag on.
For this one, the structure is a put-debit spread, maybe on a single name like AAL or UAL, keeping that same 1 to 2 week horizon. The logic is the same, just flipped.
Express a bearish view with defined risk. This gives you direct exposure to more negative news flow, like announcements of extended flight cuts. Again, max loss is just the debit you paid. And the invalidation for this thesis is simple: any credible news that a deal is imminent.
Okay, we've talked about setups. Now, we have to talk about the specific risks involved with using options.
And this is absolutely crucial. When you trade options, all of your capital is at risk, and with certain structures, it's possible to lose more than the premium you paid. This means your position sizing and your stop-loss discipline are not optional, they are critical. Remember, these are educational ideas based on the data, they are not recommendations.
So let's wrap it up. This is not trading advice, it's a market update to help keep you informed. Markets carry risk. The most important takeaways are always these: trade your own plan, manage your downside relentlessly, and always, always verify the data for yourself. Stay sharp out there.